At GoldSilver.com, we have a price match guarantee, free shipping, and global storage options. Get the best-selling book, Guide to Investing in Gold and Silver, for free at GoldSilver.com.
The next chart is a very interesting one. Mixed portfolios have suffered heavy losses so far this year. Now, you were talking about the correlation between the stock and the bond market. So take us through this chart.
Yeah, well, I mean, it shows us the tightening hasn't really started yet, and already global stock and bond markets are very 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 nervous, and it just shows us how dependent markets are on cheap liquidity. And I think that, Mike, many people tend to underestimate this degree of financialization that we're seeing nowadays. That's first of all due to the debt levels that we're experiencing, but also due to the fact that real estate markets have done so well over the last couple of years. Equity markets have done so well. Bond prices did well. So this what Murray Rothbard always said. He said for inflation, there's basically three stages. First of all, it's monetary inflation. Then this is asset price inflation. And that's the stage, that's the part of the party where everybody is super happy and everybody is excited because we're all richer. Everybody is doing so well now. And then the third stage is consumer price inflation. And now we're starting this third stage. And as I've said before, actually, it's pretty obvious that high inflation is a tough environment for bonds, but also for equities. And I think you have to be much more selective when it comes to the companies, when it comes to the sectors. It doesn't necessarily mean that all equities will do poorly, but as we're seeing with those tech stocks, those wood stocks, as they call them, referring to Katie Wood, I mean, they're down big time because tech stocks suffer from duration risks. So this chart is just telling us at some point, I think we will have to see a reversal of this hawkish policy that was announced and is just getting started. But I think they will have to reverse very, very soon, because otherwise we will see a tremendous further fall in equity and bond prices, and this will have a direct impact on the economy due to this demand and wealth destruction.
Yeah. Your next chart is one of my favorites that, I've been showing this for years. It's the Buffett indicator. You've titled it Everything Bubble, Stagflation, Everything Crash. Everybody's been I started calling this economy the everything bubble back in 2015 or something like that. But then I stopped saying that and I call it the almost everything bubble, because gold and silver are not in bubbles yet. They will be one day, but they're not there yet. It's one of the few things that you can find that didn't go into an extreme bubble. But explain the Buffett indicator to everybody and what you see in this chart.
Well, that's basically the Buffett indicator. Just it's the Wilshire 5000. That's basically the total capitalization of the U.S. equity market that divided by U.S. GDP. And we can see that, well, actually quite a lot happened already. So we are down big time from the highs, but we're still far away from the last top that was in 2000, and we are even further away from the average of 82%. Now, from my point of view, and I think you can see that with the gray bars. Actually, there should be a gray bar now on the right side, because I think that we will be in a recession very, very soon. So a recession, as we both agree, isn't something unusual. It is something healthy for the economic structure. It's healthy for the for capital formation. It's something that needs to be seen to cleanse to clean the economy from malinvestments. But we also know that before the COVID crisis, we saw the longest expansion in US history. And then we saw this tiny COVID-induced recession, which was, of course, kind of fought by very aggressive monetary stimulus, but even more aggressive fiscal stimulus. So actually, all this malinvestment that should have been liquidated already is still around. Now that tells me that, first of all, that the next recession, or the recession that we're perhaps already in, should be quite dramatic, but it also tells me that the stimulus that should be expected, monetary stimulus and fiscal stimulus again, will be even significantly higher than the 2021. Because I don't think that our dear politicians and central bankers will say, well, let's have the Austrian approach. We read our Hayek, we read our Ludwig von Mises. Let's do laissez-faire and just, let the market decide and let the market cleanse everything out. That's not going to happen. We will see much more interventionism, much more aggressive fiscal and monetary policy, and then perhaps we can get this Buffett indicator up again. But we will need much more money to get it up again.
Well, I don't call it money, I call it currency.
Yes, yeah.
Because money has to be a store of value. And the currencies are, all of the world's national fiat currencies are like skydivers that have jumped out of an airplane. And they're just falling at different rates. One seems to go up, but it's not going up. It's not falling as fast as the others.
Exactly.
And now that we've got inflation, they're all falling much faster than they were over the last 20 years. There's some data that you can do on the Federal Reserve's website that does not use it uses something other than I can't remember what it is, but it's something other than the Wilshire 5000 to put the value on companies. It's the actual market cap of all the individual companies. And that takes this chart back to the 50s, and the two charts almost overlay exactly. So it's another very reliable way of measuring this. Takes it back into the 50s. And then I have other data that creates very similar results going back in the 90 years further than this chart. And the average, we've just been in a bubble century. Since the mid to late 90s, this indicator has been out of whack because of the world's central banks just pushing everything constantly into a bubble with artificially low interest rates and currency creation. And what it showed was that between 50 and 60% is basically the average. When you go back another, it isn't 82%. 82% is what 80 to 100% is like the absolute peaks before the late 90s. It never got above that. The companies that make up the Wilshire 5000, by the way, there aren't 5,000 companies in the Wilshire 5000 anymore. They are the economy, right? These are the big companies that produce all the goods and services in the United States. They are the economy. How can they be worth twice the economy? That's just people overvaluing all of these stocks because of all of the excess currency creation, in my opinion. So, Ronnie, you got to go soon. So it's time to wrap this up. Do you want to pick one more chart to take us through here, something you see as being really important?
Well, I think, Mike, we haven't ever met in person, unfortunately, but I think we could talk for many hours, and I think we could talk about many of those charts in the report. And this is really just a summary of the whole report, which is 400 pages this year, but there's also a compact version. But we could talk about page number 30, which is obviously the price target that we are having, if you want.
That would be excellent.
So actually, we came out with our gold price model in Gold We Trust report 2020, and we said, well, we've got a inflationary decade ahead, and we were kind of ridiculed. And Mike, I worked in a bank for many years, and I know that those models, the more complex they are, the more flawed they are, and the less they work. So our gold price model is very simple. It's actually based on trust. And Paul Volcker in his book, he said, because trust is everything. So we use trust in the US dollar and trust in the financial system, as well as the backing of the US dollar of gold, and several monetary growth rates for our gold price model. Now, actually, the price of gold is doing just fine from our point of view, and it's important to say that those models are always you have to take them with a with a grain of salt. But I think it's what's really important to say is, first of all, we shouldn't be greedy. The gold price has done quite well this year, and it has stood up against collapsing equities, bonds, and especially crypto markets, as well as against the rallying US dollar. But I think that we will see really big upward momentum in the price of gold as soon as we see the turnaround in monetary policy. So I expect some sort of a last hawkish crescendo. So probably one leg lower or two legs lower for equities and yields higher. But I think it is just illusory to believe that now there's really hawkish central bankers out there. From our point, it's just they're just doves in hawk's clothes, and at some point, I think they will have to provide the market with the proverbial punch bowl again. And I think, in the monetary toolbox, there's still quite a lot of tools. As I've said before, a yield curve control, perhaps renewed rounds of quantitative easing, or even QQE, like the Japanese call it, so quantitative and qualitative easing, much more fiscal stimulus, MMT, helicopter money, CBDCs, all that stuff in the Eurozone, the introduction or the further issuance of Eurobonds. So I think there's much more to come, unfortunately. And I think that, as I've said before, I think at some point, central bankers will be pushed by markets to really make a big reversal again. And I don't think it's going to happen very, very soon. I think it's going to happen somewhere in the third quarter of this year. But this is probably going to be the point in time when gold really picks up momentum again.
Okay, so in closing, tell us about your company, what you do, and what your website is so that people can find you.
Yes. Well, I'm managing partner at Incrementum, based in Liechtenstein. It's an owner-based company, so we're 5 partners in the company. We're a boutique asset manager managing 6 investment funds. Most of them, I would say, in the precious metals and commodity space, with also 2 funds that actually combine precious metals with Bitcoin and cryptocurrencies in general. So we're definitely kind of sound money guys. We also have a wealth management department for high net worth individuals, primarily in the German speaking world. And so this is Incrementum.li. And what most people know us for is our annual In Gold We Trust report that I started writing 16 years ago. And now it's really probably the as the Wall Street Journal once called it, the gold standard of gold research, is the most widely followed publication on gold. We publish it in German, in English, but also in Mandarin, and starting this year in Spanish. So you can forward it to your friends in Puerto Rico, and yeah, it's available totally for free, and you can download it. So the big report, but also the compact version, all our chart books, our monthly gold compass on our webpage, ingoldwetrust.report.
Excellent. Well, I want to thank you very much for this interview. It's been awesome. Great work. Keep it up, and I'm sure you will. You've been doing it for 16 years now. So thanks a lot, Ronnie. We'll see you next time.
Thank you very much. All the best. It was a pleasure as always. Take care, my friend.
Bye.